Systemic risk is exploding higher, and it's not just the dreaded inversion of the yield curve. What just happened has financial insiders scrambling for answers. Should you be concerned, and should you adjust your portfolio for more risk or potentially a financial collapse? I'm going to explain this to you in one simple, fast step. Step number one, let's go over what is happening with the repo market. I said again, because those of you who watch my videos know that back in September of 2019, the repo market had a crisis moment where interest rates spiked to 10%. And this told us there was a tremendous amount of systemic risk in the system. So let's go over what is happening today. We start with a chart of the interest rate for reverse repos when the Fed is the counterparty. So the first thing that you've got to imagine is there's a big repo market. Everyone's heard of that. And this is between banks and hedge funds and whatnot, financial institutions. But the Fed does open market repo operations as well. Whether it's a reverse repo transaction or a repo transaction, the Fed is a counterparty there to backstop the market. So again, these are interest rates for reverse repos. So this means that financial institutions like money market funds are saying, hey, Fed, I want to park my dollars with you. The Fed pays them an interest rate and then gives them collateral, because basically it's this money market fund lending cash to the Fed. The way the Fed uses this as a tool is to try to set a floor for interest rates in dollar funding markets. So this chart goes all the way back to 2017, right around July, and goes all the way to today's date. On the left, we go from negative 0.5% up to 2.5%. So back in July of 2017, the reverse repo rate was 1%, or 100 basis points. I'm just going to use basis points because it's going to be much easier to compare the difference between the interest rate in reverse repo and the 1 month treasury. More on that in just a moment. And then you can see going into July of 2018, interest rates for reverse repo, 175 basis points. They went up to a peak at 225 and then all the way down to 0 with the cerveza sickness. And then interest rates on the 4-week treasury, the 1 month treasury, went negative. So they tried to bump reverse repo up to 5 basis points to try to get those interest rates into the positive. And just recently, when the Fed increased interest rates, they bumped reverse repo up to 30 basis points. So let's think this through. If the Fed is saying, hey, you can park your cash with us and we'll pay you this amount, let's say 175 basis points, so 1.75%. This is completely risk-free. So in the Fed's mind, they say, all right, no financial institution is going to lend at less than 1.75%, and no one would buy a bond that would yield less than 1.75%. Therefore, we've set a floor on interest rates. The theory is that interest rates won't go any lower, or shouldn't go any lower, than the reverse repo rate. But now let's go ahead and try to see what interest rates have done for the 1 month treasury, matching them up with the same dates that we looked at for the reverse repo rate. So going back to July 2017, again, reverse repo had 100 basis points, but the 4-week treasury was trading at 95 basis points. So less interest. So why on earth would that happen? This doesn't make any sense at all. This is what the financial insiders are trying to figure out. But don't worry, I'm going to reveal the answer to you in just a moment. But let's keep going through these interest rates and see how they match up. So moving on to July of 2018, reverse repo, 175 basis points. Now the 1-month Treasury at 189. So it's actually 14 basis points higher. This is what you would expect. But now let's move on to July 2019. Reverse repo, 225 basis points, 217 for the 1-month Treasury. Once again, it's lower, this time by 8 basis points. So moving on to July during the cerveza sickness, as you would imagine, reverse repo at 0%. And the 4-week Treasury trading at 14 basis points. So now it's 14 basis points above reverse repo. And then we move on to 2021. Again, it's above reverse repo. But what has happened just recently when the Fed raised rates to 30 basis points? The 4-week Treasury only went up to 14. So now we have a deficit of 16 basis points. In other words, you're only being paid half the interest to hold a 4-week Treasury than you would be just by parking the cash at the Fed. So why would any financial institution do this? This is something the people at the Fed, the 900 PhDs, thought was impossible. Well, I'm going to give you a quick hint. Look at this key right here that I've got written in green. It happened right around August of 2019, and it just happened a couple days ago. You guys probably guessed it. That was an inversion of the yield curve between the 2s and the 10s. This is a very ominous warning that has predicted almost every single recession we have had going back to 1950. So the first main reason why a financial institution would prefer to own a 4-week T-bill as opposed to just parking their cash at the Fed is because they see massive amounts of systemic risk in the financial system. The second reason, which is pretty much the complete opposite, is where they don't see much risk at all, so they're trying to get more aggressive and expand their balance sheet, use more leverage. I'm going to explain how they do this in just a moment. And the third reason, which you could probably already guess, would be good old-fashioned supply. So how many of these T-bills is Janet Yellen issuing at auction? How much deficit spending is the government doing? And how many of those T-bills is Jerome Powell taking off the market through quantitative easing? Or how many T-bills is he leaving in the market by not doing quantitative easing? Remember, they've tapered down to 0. Or how many T-bills is he selling back into the market, increasing the supply by doing quantitative tightening? The supply side of the equation makes this very complex. So let's go ahead and shelf that momentarily. We're going to revisit it at the end of the video. But right now, let's focus on the demand side of the equation. So why on earth would these financial institutions prefer to have a T-bill other than just parking the cash at the Fed and get a higher interest rate? Number one would be financial engineering. And I've got kind of an example of that right here. You guys have all heard of rehypothecation. This is where a financial institution, I've got an example of the balance sheet. We've got assets on the left, liabilities on the right. If they buy this T-bill, they can go ahead and lend that out to other parties. And those other parties can use that T-bill as collateral even if they really don't own it, if they're just borrowing it. And of course, that initial financial institution can charge a fee, and therefore the fees that they collect from all of these institutions they're lending that treasury out to can equal more interest than they would get at the Fed. Professionals in the industry, like my good buddy Jeff Snyder, call this a collateral multiplier. So this would be an example of the market taking more risk or being more aggressive with their balance sheet, or a risk-on type of atmosphere. Now let's go over why a T-bill would be optimal for a lot of these financial institutions if there was a collapse in the system, a financial crisis. As we stated earlier, those 4-week T-bills are trading about 14 basis points. But earlier, about a year ago, year and a half, they were trading at a negative rate. That's why the Fed had to bring the reverse repo rate from 0 up to 5 basis points. So if we had a financial crisis similar to what we saw in 2008 with the GFC, the interest rate on these T-bills would go down. So if the interest rate on these T-bills goes down, what's happening to the price? There's an inverse relationship, right? So if the interest rate on a T-bill, or any bond for that matter, is 10% and it goes down to 0, what happens to the value of that bond? Goes up. What happens if it goes down to negative 10%? Just using an extreme example. It goes way, way, way up. Therefore, if there is a risk-off event or a financial crisis, the value of those T-bills are going to increase tremendously, where the value of having your cash parked at the Fed isn't going to increase at all. Oh, but wait, there is more. I've got another example as to why it may be preferable for these financial institutions to hold T-bills over just parking cash at the Fed. In this example, we've got two banksters, everyone's favorite group of people. We've got Bankster Bill and Bankster Bob. Below Bankster Bob, we've got the regulator, Regulator Rick. So Bill's balance sheet is right here. Bob's balance sheet right here. Assets on the left, liabilities on the right. So it starts off with Bob owning some pristine collateral, one of these T-bills we're talking about, and he's only getting 14 basis points, so 0.14%. But he's got some garbage assets as well, the type of assets that the regulators really don't like. But the good news is because these assets are incredibly risky, he's getting a 10% return, a 10% yield. Incredible. But what Bob can do is he can go over to his buddy Bill and say, Bill, I need some insurance on this garbage asset I have. And Bill looks at his balance sheet and says, well, you don't have any of those bank reserves, but you do have treasuries. And I know they are the best. They are the pristine collateral. So I'll go ahead and give you the insurance you need. So why does Bob want the insurance? Because if he has insurance on his garbage asset, in the eyes of the regulator, it turns into a pristine asset, just like the T-bill that's only yielding 14 basis points. So Bob pays Bill 1%, let's say, just for the insurance. Bill pockets the money. Bob all of a sudden has the assets he needs in the eyes of the regulator, or the security of the asset side of his balance sheet that he needs for the regulator, let's say for Basel III. But the difference is now, instead of just making this measly 14 basis points or measly 30 basis points at the Fed, he's making 900 basis points, or 9%. And the point here is he might not have been able to get the insurance in the first place, or he most likely would have had to pay a much higher interest rate if he didn't have those T-bills to begin with. So the bottom line is, on the demand side of the equation, you've got to get your head around the fact that at certain times, these financial institutions would prefer T-bills at a lower interest rate than parking their cash at the Fed. So then the question becomes, at the times when we see this huge delta, like we see now, where the 4-week Treasury is trading way below reverse repo, why is it happening? Well, this is when we have to go back to the key that I was talking about earlier, that we saw just a couple days ago, and we saw back in August of 2019. That's an inversion of the yield curve. The entire market knows this is a huge red flag, a warning sign that most likely recession is to come. So this means the probability of a financial crisis has increased. I'm not saying it's 100%, but it's a lot higher than it was, let's say, even 3 or 4 weeks ago. So because we see this extreme difference, 16 basis points It would lead me to believe that the financial institutions, these financial insiders, see systemic risk exploding higher. And keep in mind, this is at a time when the Fed has stopped quantitative easing. Therefore, you could safely assume that the available supply of these T-bills was greater than it was back when the 4-week T-bill was trading at a higher interest rate. In other words, if the Fed was still doing quantitative easing, the 4-week T-bill most likely wouldn't be trading at 14 basis points. It would probably be 10, maybe even 5 basis points, making this delta even more extreme, which would signal even greater counterparty risk or potential financial crisis. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.